Creating a trading plan that actually works is a difficult process, so I'm here to help. I've done this before for myself, and I've done this for other students like yourself that actually bring in results. Now, this video is absolutely perfect to follow along with everything that I do, so also feel free to open up a chart. Now, to get to your trading plan, we are going to go over 3 steps. And the first step is the PD rate. The second step is the data. The third step is the plan. Now, before diving into step 1, let me give you a bit of a backstory. This, what I'm about to show you, is exactly how I got to my first ever trading plan that was profitable. The first thing I did when I was learning about trading is I started to look at the lower time frame. As with any other trader that just starts out, I thought that's where the magic happens. That's where I need to be. And every single day that passed by, I would notice that certain fair value gaps just held. They followed through perfectly, and if I was to enter off those fair value gaps, I would have gotten a lot of profit. So then the question rose, why do certain of those fair value gaps actually hold? At first, I would just buy at any 5-minute fair value gap or short at any 5-minute bearish fair value gap, and this obviously didn't work out that well. So I had to figure out, well, why are those certain fair value gaps actually holding and why are others not holding? And that is where we then start noticing a certain pattern that leads to those fair value gaps actually holding. So what are we doing? We are reverse engineering a trading plan where we start at the entry and we build our way up. And in this way, we can create a foundation of a strong trading plan. And that leads us to step number 1, the PD rate. In step number 1, I want to ask you, which PD rate do you want to enter on and which time frame do you want to enter on? Those 2 questions need to be answered. Now, how can we answer those 2 questions? Let's start off with the first question, which was, what PD rate do you want to enter on? How do you know that? Well, which PD rate resonates with you? What does that mean? If I explain to you a fair value gap, an order block, a swing high, swing low, and there's one PD rate that really stands out, as in you just understand it, it just resonates with you. So if you open up a chart, what is the first thing that comes to mind for you? Is it a fair value gap? Is it an order block, a mitigation block, a breaker block? The PD rate that pops out to your eye and that is easy to understand for you, that you find interesting, that is the one that you want to choose. So for me, and I think my videos reflect that, that has always been fair value gaps. So my whole trading plan and everything I basically do is all based around one single PD rate, and that is fair value gaps. So in this video, for the examples, we are going to use fair value gaps. But if it's order blocks for you, then you can just simply replace the fair value gaps with order blocks. Now, second question, which time frame do you want to enter on? This all depends what type of lifestyle you have. For example, if you have quite some time and you can actually focus on one single session for 3 hours, then the 1-minute time frame might be very interesting to you. But if you also have something next to trading, or you don't want to spend a lot of time behind the charts, then you can also opt for a higher time frame. Now, the main time frames I would like you to choose from are the 1 minute, the 5 minute, the 15 minute, the 1 hour, the 4 hour, the daily, weekly, and potentially monthly. That is going to be your entry time frame. Now, if you're not certain which time frame you should choose, don't worry about it too much. You can always change the time frame you want to enter on, because the trading plan that we are actually going to build is not reliant on one time frame, meaning the trading plan works on any given time frame. Now, for my current life, I would like to use the 1 hour time frame. So I want to focus on 1 hour fair value gaps. We want to gather the following data. How many times does the fair value gap show up? How many times does the fair value gap hold? And how many times does the fair value gap fail? Now, looking at the screen, on the right side, we have our trading view. On the left side, we have a Notion where I gathered the data. I want to first of all clear a few things up. I gathered the data in the following manner. I was only looking at fair value gaps in the most recent leg. Now, I'll explain that a little bit more clearly later on. Then the second one, holding, means an FVG was traded back into and created a new FVG before taking out the leg the FVG is in. It's quite a mouthful. Let's explain that. So for example, this is a fair value gap right there that actually held, because this fair value gap right there eventually created a new fair value gap, a new bearish fair value gap in the same direction before it took out the lag right there. And to understand a lag, when we have a bearish lag, it's a swing high to then followed by a fair value gap. If we have a bullish lag, that means we are having a swing low followed by a fair value gap. So for example, this fair value gap right here in this bullish lag did not hold because we took out the swing low right there and then continued higher. But this bearish fair value gap right here did hold because we created a new fair value gap right there before taking out this swing high. All right, then we need to understand the data is collected from 1 hour fair value gaps on GBP US dollar right there between Monday, June 17th, 2024, 12 a.m. New York local time, and Wednesday, June 26th, 2024, 8 p.m. New York local time. Or simply said, whilst I'm recording this video, the last 2 weeks. All right, then looking at the chart on GBP US dollar and opening the object tree, we have the first 3 maps that are important right now. We have a map with not traded into fair value gaps. These are fair value gaps that have not been traded into immediately, meaning we have created multiple lags before trading back into those. So again, remember when we said only looking at fair value gaps in the most recent lag. Those are not the most recent lags anymore. So those fair value gaps are not that relevant. Then we have the fair value gaps in the map did not hold. In other words, they did not create a new fair value gap before the lag that the fair value gap is in was taken out. And then we have the fair value gaps in the map that held. So all these fair value gaps held. In other words, they created a new fair value gap in the same direction without taking out the lag that they are in. So in total, this leads to a sample size of 39 fair value gaps. Now, off of those 39 fair value gaps, we have 13 orange fair value gaps, meaning they were not directly traded into. Off of those 13 orange fair value gaps, only 1 of those fair value gaps actually held, meaning we had a sting into that fair value gap, and then we created a new fair value gap, which is this fair value gap right here on the left. Off of this fair value gap, we actually had a sting into it to then follow through higher with a new fair value gap. That means in this sample size, the fair value gaps that have not been traded into have a holding rate of 7.69%. So we can determine of those 39 fair value gaps that 13 of those are just extremely low probability. So we don't want to use those. We want to focus on the 26 that are left. And those 26 fair value gaps that are left are always in the most recent lag. Then on the trading view, we see the 26 usable fair value gaps, so that are in the most recent lags. Off of those 26 usable fair value gaps, we have 14 fair value gaps that did not hold. And we have 12 fair value gaps, the green ones, that did hold. This creates already a holding rate of 46.15%, meaning that if you were to trade off of any of these fair value gaps, the chances of them holding is 46.15% in this sample size. Again, understanding that we are dealing with 2 weeks of trading right here. The more data we have, the more reliable the data is also going to be. So if you're going to do this, then you can gather a lot of data and you don't have to backtest for that. You can simply do this in hindsight. So now you can imagine the younger version of Arjo was quite excited because now we have some data to deal with and we can actually know which fair value gaps want to hold and which don't want to hold through exploring patterns. Which leads me to step number 3, the plan. Now that we have the data, we again want to find the reason why certain fair value gaps hold and why others do not hold. This can be done by seeing what led up to the moment of a fair value gap holding. Meaning, if we go up in time frames, for example, what is happening on the higher time frame whilst that fair value gap is holding? Is there a certain technical pattern that can be found? Or is there a specific time when those fair value gaps hold? Now, once you start recognizing those patterns, you now have the basis, the foundation of your trading plan. Now, of course, I'll help you out right here. And I've already gone over a few scenarios. In the Notion on the left side, if we now look at step number 3, the plan right there, and we unfold that, then we'll start off with trading plan number 1, which is trades all usable fair value gaps. So the first thing that we can do is create a naked trading plan, meaning all the usable fair value gaps that we have noted down right here. What if we simply enter on all of them? And that leads to this result right here, where we have a lot of different trades and we create the following outcome. In the Notion, I've written down, if you were to trade off of all the usable fair value gaps with the following rules, covering the swing point of the leg, meaning if we have this fair value gap right there, we enter on the fair value gap itself and we cover the swing high right there of that leg. If it's a bullish leg, then we cover the swing low. Then we target 2RR and we don't go break even. So it's either take profit or it's a loss. That leads to the following thing. I've gathered the data right there of all the trades that you're seeing right here. This, of course, there's 26 fair value gaps, so it leads to 26 trades. 11 of those trades are winning trades. 15 of those trades are losing trades. That creates a win rate of 42.31%, a little bit lower than the holding rate that we had of fair value gaps. This then creates a profit and a return, if you were to risk 1% on all of these trades, of 7%, in other words, 7RR. Now, you might be like, well, let me just go ahead and enter on every 1 hour fair value gap from now on. Again, we also need to take something into account, and that is psychology. Our technical plan needs to be in alignment with psychology. In other words, the trading plan needs to make it easy to not mess up in our psychology. So to not get a lot of emotions and we start over trading. And that is a small detail that a lot of people forget. For example, if we were to take all these trades right here, then you would come across as well a 4-trade losing streak right there and potentially even bigger, because that is only in this sample size that we have right here. So can your psychology actually take it if you were to take every single fair value gap? As in, if you are in that 4 losing streak, can you keep your psychology in check to not mess up and now start over trading? Because those are 4 hits that you are taking. So in my eyes, I like to have a little bit of a higher win rate, so I take less hits before I take the next winner. Because with a losing streak, what happens is after the first trade that you lose, you take a hit. So what are the chances that you might do something that is not in the trading plan anymore? And you might start taking weird trades because you can't control your emotions anymore. And then you take another hit, a second hit, and that is another moment where you get tested, where your psychology gets a hit. And if you keep on taking hits, then it's only a matter of time before your psychology can't take it anymore and you will start over trading, revenge trading. And that is, of course, not what we want to do, because then we don't lose -1, we lose -10 potentially, or we lose the whole account. So then what I wanted to do is, all right, so what if we only enter off of fair value gaps that are coming off of a previous fair value gap that held, which leads to the following trades right here. These trades are all trades off of fair value gaps where the previous fair value gaps held. Meaning, see how this fair value gap right here followed through with a new fair value gap, then you would enter on the new fair value gap right there. This creates the following data. With the following rules, the FVG needs to be created off a previous fair value gap. Again, same things, covering the swing point of the leg, targeting 2RR, and no break even. So just creating that raw data, that's important. Then you have the following trades right there, which leads to 12 total trades, 6 winning trades, 6 losing trades with a win rate of 50% and a profit of 6% or 6RR, which is better and is overall a good trading plan, but it's not quite there. Which then leads me to the understanding, well, what if we were to only enter off of fair value gaps that are in alignment with a daily context? Let's first understand what context means. Context is the following. If we have context, we are moving off of a PD array to a next PD array. That creates a context area. So in this case, we are using fair value gaps. Here on the daily, we have this daily fair value gap, and we also have this daily fair value gap right there. Now, if we continue lower off of those daily fair value gaps, it will encounter a first discount array because we're coming off of a premium array right there, which is the fair value gap. The first discount array in these cases are these swing lows right there. This then creates something known as a context area. where from the highest point that we sting into those fair value gaps towards this swing low, that is where we can look for entries. That is a context area. So this right here is a higher time frame technical pattern where we can potentially see, hey, if we trade within that technical pattern on a time frame above us, the 1 hour value gaps have a lot higher probability of holding. So let's actually see if that's true. These are all the trades right here inside the daily context. We have the gray boxes, the big gray boxes, which are the daily fair value gaps, and we have the lines at the bottom, which is where the context ends, because that is where we reach that opposing first PD array. Now, taking a look at the notion, if you were to trade off all the usable fair value gaps in line with daily context, following rules, only trades within the context area, which is again from the daily value gap to the first opposing PD array. And the other 3 rules are the exact same like we have discussed before. This leads to the following trades right there, which leads to 13 total trades. 9 of them are winning trades, 4 of those are losing trades, with a total win rate of 69.23% and a total profit of 10%, or in other words, 10 RR. So now we understand that if we take every single fair value gap right there as a trading ID within that daily context, then we already have a lot higher probability fair value gaps. And that is just simply because we now have the higher time frame supporting the ID. And to add on to the backstory, this is exactly how I got to the understanding of where fair value gaps are more likely to hold. This is how I got to the understanding of context areas, all through my own experience. I didn't have anyone telling me, hey, if you look at a context area, you have a lot higher probability trades. So take advantage of that knowledge. So this trading plan is good, but I wanted to test one more thing, because what if we now combine those fair value gaps that held and as well inside that daily context area? Well, then we get to the following trade IDs right here, where we can see we have a lot less trading IDs, but a lot higher probability. So if we again take a look at the notion, if you were to trade off of all the usable fair value gaps that previously had a fair value gap holding and in line with daily context. So fair value gap needs to be created off a previous fair value gap, only trades within the context areas, and again, the rest of the rules are all the same. Then these are all the trades that we can get to right there, which leads to a total of 7 trades. 5 of those are winning trades, 2 of those are losing trades. That is a win rate of 71.43%, which is a little bit higher than the previous trading plan, and the profit is a little bit lower, which is 8%. So we take less trades, we make a little bit less profit, but we take a lot higher probability trades. Now, there is a downfall here, because if you now start adding rules onto rules onto rules, where you try to filter out all the losing trades, then you are going to go through the exact same cycle that I have also been through, where you add too many rules and you need to read a whole chapter of a book before you can dive into your chart. How many pips is this fair value gap? Is this fair value gap exactly created at 3:10 a.m. New York local time? And then you will be taking one trade every full moon cycle. So there's one extreme where you take too many trades, and there's also another extreme where you take too little trades. We need to find the balance. And once we find that balance, we have a very strong foundation of a trading plan. And when we have a strong foundation, we can build on to that. And this whole process is what then led me to the following understanding. The 5 foundational levels, where we have the first one, which is bias. The second one is narrative. The third one is context. Fourth one is entry. And the fifth and last one is risk management. And you might see, hey, we have started at foundational level number 4, the entry. Yes, because we are reverse engineering the trading plan, where we then got to the understanding, hey, if I now incorporate context, it's a lot higher probability. And now I can potentially look at narrative. So how can I now find the highest probability context? How can I now find the highest probability narrative? How can I make sure that I now find the best bias? All based by just looking at number 4 first, the entry. And then your whole trading plan will be based around one singular PD array. In the MMT, I provide people with a lot of different trading plans, but I also tell you how to get to your own trading plan. which is arguably even more valuable. There's a link in the description with all the data that I have gathered for this video. Then I wish you the best of luck, always here when you need me, and you got this. All right, perfect. Thank you.